What is a bank? Think of a bank like a big, safe piggy bank for your money. You put your money in and the bank keeps it secure. But banks do more than just hold on to your cash. They lend some of that money to other people and businesses. This borrowing and lending is a big part of how our economy works. Let's say you want to buy a house. That's a lot of money. Most people don't have that kind of cash just lying around, so they go to a bank to get a loan. The bank provides the money and the borrower pays it back over time, usually with a little extra added on. Banks are essential for individuals and businesses alike. They provide a safe place to keep our money and they help us achieve our financial goals by providing loans. Without banks, our financial world would look a lot different and not for the better. Banks don't work for free. How do banks make money? Banks are businesses, and like all businesses, they need to make money to stay open. How do they do it? Interest and fees. Remember those loans banks give out? They charge something called interest on that borrowed money. Think of it like a rental fee for using the bank's money. The interest rate determines how much extra the borrower pays back. Banks also charge fees for various services. These might include monthly account fees, overdraft fees, or fees for using an ATM that belongs to a different bank. While these fees might seem annoying, they're essential for banks to cover their operating costs, pay their employees, and yes, even make a profit. Here's where things get really interesting. Banks don't actually keep all of your deposited money locked away in a vault. They only keep a small fraction of it on hand, called the reserve requirement. The rest of the money, they lend it out. This system is called fractional reserve banking. Let's say you deposit $100 into your bank account. The bank might keep $10 as a reserve and lend out the other $90 to someone else. The person who borrowed that $90 might then deposit it into their own account at a different bank. That second bank can then turn around and lend out a portion of that $90 and so on. This process repeats itself with the same initial deposit being multiplied through the banking system, creating new money in the economy. Fractional reserve banking is a powerful tool that helps fuel economic growth. Lending money always involves a certain amount of risk. There's always the chance that the borrower won't be able to pay back the loan. Banks have to be very careful about managing this risk. They do this in a couple of ways. First, they carefully assess the creditworthiness of potential borrowers. They look at your credit history, income, and other factors to determine how likely you are to repay the loan. Second, banks adjust interest rates based on the level of risk involved. Loans considered riskier will typically come with higher interest rates. This helps to compensate the bank for the increased likelihood of not getting their money back. Managing risk is a delicate balancing act for banks. They want to lend money to earn a profit, but they also need to protect themselves from potential losses. Not all banks are created equal. There are different types of banks that specialize in providing different kinds of financial services. Commercial banks are the most common type. They serve individuals and businesses, offering a wide range of services like checking and savings accounts, loans, credit cards, and more. Investment banks focus on helping businesses raise capital by issuing stocks and bonds. They also engage in more complex financial transactions like mergers and acquisitions. Central banks, like the Federal Reserve in the United States, are responsible for overseeing the entire banking system and managing the country's monetary policy. Understanding the different types of banks helps us navigate the financial world and choose the right institutions to meet our specific needs. Imagine a world without rules or referees. It would be chaotic. The same goes for the financial world. That's where financial regulation comes in. Financial regulations are rules and laws put in place by governments to ensure the stability and fairness of the financial system. These regulations cover a wide range of areas, including capital requirements. Banks are required to hold a certain amount of capital in reserve to absorb potential losses. Consumer protection laws protect consumers from unfair lending practices and ensure transparency in financial products. Anti-money laundering regulations help prevent criminals from using banks to launder illegal funds. Financial regulations are essential for maintaining confidence in the banking system and protecting consumers from harm. Central banks play a crucial role in the economy. They act as the bank for other banks and the government. They don't deal with individuals directly. One of their primary responsibilities is to control a country's money supply. They do this through a few key tools, including setting interest rates. By adjusting interest rates, central banks can influence borrowing and spending in the economy. Open market operations, buying or selling government bonds to increase or decrease the amount of money in circulation. Reserve requirements, setting the percentage of deposits that banks are required to hold in reserve. Central banks are powerful institutions with a significant impact on economic growth, inflation, and employment. The financial system is complex and interconnected. When one part of the system fails, it can have a ripple effect throughout the entire economy. This is what happened during the financial crisis of 2008. The crisis was triggered by a combination of factors, including subprime mortgages, loans given to borrowers with poor credit history and a high risk of default, housing bubble, a rapid increase in housing prices that proved unsustainable, securitization, packaging mortgages into complex financial instruments that were sold to investors. When the housing bubble burst and people began defaulting on their mortgages, it triggered a chain reaction that led to the collapse of major financial institutions and a severe recession. Financial crises are a stark reminder of the importance of sound banking practices, effective regulation, and responsible lending. The financial crisis of 2008 provided many valuable lessons about the banking system. It highlighted the dangers of lax lending standards, giving loans to borrowers who are unlikely to repay them. Excessive risk-taking, engaging in financial transactions that are too risky. Lack of transparency, making it difficult for investors and regulators to understand the true risks involved in complex financial products. The crisis led to significant reforms in the financial industry, including increased capital requirements. Banks are now required to hold more capital in reserve to protect against losses. Stricter lending standards. It is now more difficult for borrowers with poor credit to obtain loans. Greater oversight and regulation. Regulators now have more power to monitor and supervise financial institutions. By learning from past mistakes and implementing necessary reforms, we can work towards a more stable and resilient financial system.